Hey, how you doing? This is Adam Post. Warner Brothers has a little bit of a debt problem. Interest rates are high. They still have $37 billion of debt. They've been doing good. They've been paying it down, but it's still high. Cable channels are not worth as much as they used to be. That's a big part of their business. Their streaming service is doing kind of okay, but it's not doing phenomenal. And their studio also doing okay. Minecraft, Barbie, okay, sure, but that's not going to cover $37 billion worth of debt, especially now that interest rates, completely outside of the control of Warner Brothers, have gone through the roof. So Warner Brothers Discovery needs to split into two pieces. Now you can't try this at home. You can't go ahead and take your credit card and say, you know what, how about if I take a pair of scissors, we all have those, cut my credit card in half, and then now I have it in two pieces. So how does that help me pay off my credit card? It's not really going to work with a credit card, but it will work in this case with this business. This is not investment advice, but I do like what they're trying to do here. Studios and streaming is kind of a compelling business. That's going to be one of their businesses. The other business is going to pretty much be the cable channels, which do actually bring in a bunch of money. And to make this whole thing work, they're going to take most of this $37 billion that they owe, which kind of is a lot of money, and then move that over to the cable channels. The cable channel company will still own up to, they say, 20% of the studio and the streaming business. This kind of financial capital structure thing where they figure out, okay, we'll put this over here, we'll put that over there, we'll have this debt over here and that investment over there. It does work out if you do it right. It's not that they didn't do it right the first time out when they did the big merger with Warner Brothers and Discovery. It's that they wound up valuing Warner Brothers way too high when they did the merger, and that was kind of beyond their control. The market changed on them almost as soon as the transaction got done. The other problem they have is, like many companies, they do have debt. They were highly leveraged. All the private equity companies are doing leverage deals like this where they have a lot of debt and only a little money down. When they take over a company, that's absolutely normal. But a couple of years ago, we had an administration in this country that caused our interest rates to go really high because of inflation. When a company has a lot of debt on it and all of a sudden the interest rates go up, the value of that company is going to go down. It's physics. There's really no way to control that. If interest rates also go up, and you have a house, for example, and someone who would come and say, buy your house, let's say your house is worth $1 million, and interest rates are relatively low at, say, 2 or 3%, just low numbers. And now all of a sudden, because of some strange government moves, not even things that you did, interest rates go up to 7 or 8%. That makes the value of your house less because someone needs to buy and finance that house. Some people do, but very few people pay all cash when they buy a house. The higher interest rates are, the lower the value of any asset, whether it's your house or it's a company in almost all cases. Now let's do some strategic finance and check out this deal. From CNBC.com, Warner Brothers Discovery to split into two public companies by next year. From The Hollywood Reporter, David Zaslav finally cuts the cord, cutting the cord to cable. Bank of America sees upside in a Warner Brothers Discovery split. It's going to work, and here's why. A future industry is going to be studios mixed with streaming. Streaming is going to definitely be a big part of it. That new Warner Brothers focused company is going to do well. Studios and streaming is how they refer to it. The cable channels, they may do okay. They may not do all that great. They'll no doubt be able to pay off their debts, and they will have a stake, they're saying up to 20%, of the new streaming and studios business. So it should do okay. So the market for people that want to invest in the cash-generating, dying out, but cash-generating cable industry business can invest in the cable channel company of theirs. The people that are interested in streaming and studio and the licensing and all the things that might happen with the future DC universe can invest in that separate Warner Brothers company, the studio and streaming side. When you combine those two things, as they've done, they've noticed they can't really find a good market for their stock. Their stock has not done well because it has an overhang. It has like this punishment of even if you have a hit movie or you have a hit video game and you own a lot of intellectual property, you still have this big cable business and you still have all this debt. And the one thing that will crush a growing company that might even become a hot company is a lot of unmanageable debt. You need to be able to not have that much debt to grow aggressively, make investments, and attract people to the business. Also, when you want to try to attract employees and give them stock options, have them invest themselves in a company, there are executives and people that will want to be part of a hot company, a company in the streaming business, a company in the movie studio business, but don't want to be associated with the cable industry. And another thing that they found is that the cable channel programming doesn't really translate to streaming. They've done a little bit of crossover, but they've said, look, it's just not really working for us. And as a result, they say they're going to go with more quality than quantity for the streaming service. They do have HBO that will be part of the studios and streaming business. HBO is known for quality. They can do quality. They just have to decide, yeah, we're going to do this and we're not going to continue to try to push cable content on our streaming service. The value of Warner Brothers Discovery today is around $23 billion. That includes all the debt, all the value of the stock, all combined $23.48 billion. The goal in splitting the company into two pieces would be to create something like a $5 to $10 billion benefit for the equity of the two companies, or at least a future to be able to generate that kind of a benefit by operating them separately. That kind of benefit can happen because they're changing the identity of the two separate companies from the one combined company. There are people that will be in a market for buying into something, and there are people that will be willing to buy into something else. It's almost like you can't meet people unless you go out where people are. And you're going to meet certain people in a bar, and you're going to meet other people at a wedding, let's say. A bar is fine, a wedding is fine, but if you're trying to get all of your value and meet everyone that you're ever going to know or be friends with or maybe fall in love with or do business with at a bar, it's a different class of people than if you get to a museum, a wedding, and you put yourself in the market where you're going to be the most highly valued and also make the most highly valued transactions. From CNBC.com, Warner Brothers Discovery to split into two public companies by next year. This is just the latest upheaval in the industry as consumers transition from cable into streaming. The company will separate into a streaming and studios company, which will include its movie properties and streaming service HBO Max, and a global networks company, which will include CNN, TNT Sports, and Discovery, among other businesses, including DC Comics, and also the DC Comics movie studio. CEO David Zaslav will lead the streaming and studios company. Current CFO Gunnar Wiedenfels will become the CEO of the global networks business, which is a great choice. Gunnar Wiedenfels is very sharp. He's created a lot of value for Warner Brothers Discovery, but also Discovery before that as they handle a lot of other mergers with international cable companies. He's a sharp guy, and ultimately a CFO that really understands the numbers and has a good relationship with investors and banks, can give assurance to investors that these guys know what they're doing. It's going to continue in a smart way. The company right now expects to complete the split by the middle of 2026. Quote, by operating two distinct and optimized companies in the future, we're empowering these iconic brands with sharper focus and strategic flexibility that they need to compete most effectively in today's evolving media landscape, according to David Zaslav. He's right, there's a lot more value with the companies separated than having them together. The companies couldn't start off separated, you had to combine them to be able to separate them. And there was no one else out there willing to pay more money for Warner Brothers than the valuation got when Discovery did the merger with AT&T. The news confirms earlier reporting by CNBC and others that Warner Bros. Discovery was considering such a split. In December, the company announced restructuring that many saw as a precursor to a full break. Warner Bros. Discovery joins cable giant Comcast in separating out its traditional pay TV networks from its broader media business. Comcast NBC Universal is currently in the process of spinning out its portfolio of cable networks, including CNBC, into a new publicly traded company called Versant. At least they finally came up with a name. NBC Universal will continue to oversee streaming service Peacock, NBC's broadcast network, and the film business, among other assets. The issue really is nobody knows how bad it's going to get with the cable companies. How low is the value of cable channels really going to be? 1 year from now, 2 years from now, 5 years from now, we just don't know. So having that inside the company along with a lot of debt just doesn't really make sense for these companies anymore. Warner Brothers has the largest portfolio of cable TV networks, which was born from the 2022 merger between Warner Brothers and Discovery, which brought together channels like CNN, TBS, and TNT with Discovery, TLC, and HGTV. The move from both Warner Brothers and Comcast come as the industry has been contending with the loss of customers from traditional pay TV bundles in favor of streaming. A key focus has been building up streaming platforms and particularly reaching profitability. When Discovery merged with Warner Brothers, profitability really wasn't a big issue. Investors didn't care much about whether or not a streaming service was or was not profitable. And then they merged with Warner Brothers, took on their entire ownership of the studios, TV catalog, cable channels, streaming service, you name it, and then the value of streaming services got reevaluated based on, well, okay, but when are you going to be profitable? It's like, well, we just merged, and the problem wasn't really their merger. The problem was a change in the industry where investors finally started to realize that just producing a lot of shows doesn't mean you're going to ever produce a profit, and then being in the streaming business doesn't necessarily mean anything unless you can actually eventually make a profit. Like inflation and high interest rates, that's nothing they could have ever controlled, but as a result, the value of their stock is down, and really they have no choice. They have to do this split. There is no way they can fix Warner Brothers Discovery the way it is now and create any value for stockholders. And not creating value doesn't mean the company goes out of business, or doesn't mean the company's not even profitable, doesn't mean the company can't pay down debt. They can do all of that, but it's going to take them forever to get anywhere. Traditional pay TV's drag on the broader media business was showcased last year when Warner Bros. Discovery reported a $9.1 billion write-down, which is to say a permanent loss. A write-down is a permanent loss of value that you do not see a realistic way to recover. So they took that $9.1 billion loss on its TV networks business. The company said the move was triggered by a reevaluation of the book value of the TV network segment. Now they can get a tax benefit from that because they can say, oh, now that we have this write-down, we can pay less income tax because we're taking this loss. It gets a little complicated, but it does help the business overall. It just means, though, that the business overall is worth less money. It's a corporate finance thing. It does get complicated. Still, the traditional TV networks remain profitable for Warner Brothers and generate hefty amounts of cash. Live sports aired on traditional TV still bring in the biggest live audiences, making sports essential to the portfolio of most media companies. Chief Financial Officer Wiedenfels noted on a call with investors on Monday that much of the free cash flow generated from the traditional TV business over the years has been used to build up the streaming platform. But while the cash from the traditional business has propped up streaming, the content hasn't translated for the Max platform, which is being renamed again to HBO Max. In May, when the company announced the name change, it also added that the streaming platform would focus more on quality over quantity. During Monday's call, Zaslav said sports hadn't been a real driver for the streaming platform. If the cable content doesn't really help them on the streaming service, doesn't help them get engagement from consumers, subscribers who are following the streaming service, if they're not going to get new subscribers because of their cable content, they really do have to get rid of the cable content because while it does make them some cash, it doesn't work strategically. It's not really part of the future business. And the market perceives it as a negative. In some circles, certain things are considered attractive. Some people think it's cool if you have gold teeth. Some people think it's cool if you have gray hair. Other people think it's cool if you have tattoos. What a company has to figure out is, what do our investors think is cool? And I think they've kind of figured it out now. They don't think that cable channels with tens of billions of dollars of debt attached to them are very cool. So if you get that out of the company, it gives them a chance to be more cool. Metaphorically speaking, cable channels are the tramp stamp of media companies. On Monday's call, Warner Bros. Discovery executives emphasized that each company would be, quote, free and clear from a transaction perspective. While the split is tax-free, executives would be willing to forego that benefit to do the right deal, according to a person close to the matter who wasn't authorized to speak about potential mergers and acquisitions publicly. It's not impossible another company could come in and say, hey, let's make some kind of a deal, and if they did, there could be some tax implication. That's all they're talking about. I wouldn't expect that to happen. I think most of the value in these companies is going to be established by a successful launch on the public markets. So when they split the company into two different stocks, they will have pre-selected, I'm sure, some investors that will back the new structures of the companies. They think these things out carefully in advance. The first merger with Warner Brothers and Discovery was carefully figured out, but the market changed. You can't control the market when the market changes. That's one of the problems. You can't control interest rates. If you're the Fed, you can control interest rates to some extent. But if you're not the Fed, if you're just like a private guy or maybe the president of the United States, you don't get to control interest rates. You just have to be careful and try to be strategic and plan these things out the best you can, which they did, and now they're trying to do it again. Zazie has called for deregulation and a push for more consolidation in the media industry, which he said is going through a period of generational disruption. It is. Obviously, there are massive changes going on in media. We didn't even used to have streaming services if you go back not that far. And the prevalence and relevance of streaming services in media is now so important, it's so big, that it's not just changed the streaming services industry, but all of the entertainment industry. So yes, it is a generational disruption. And the end of cable channels, they started to become big in like the 1980s or something. Yes, there is a generational change going on, something that only happens like once every 20, 30, 50 years or so. If there is deregulation, what he's asking for is an opportunity for companies to get efficiencies by merging, laying people off, or doing different kinds of transactions to try to adjust to the new realities of the industry. And it's up to the federal government to want to cooperate or not when it comes to deregulation. NBC Universal's separation of its cable networks is meant to give it further opportunity to invest in its business and also merge with other networks, according to CNBC. Their spin-off company, Versant CEO Mark Lazarus, told CNBC that the spun-out company aims to be acquisitive, meaning they would acquire other companies. The current Warner Brothers Discovery is a product of consolidation. Warner Media and Discovery merged in 2022, bringing together Warner Media's portfolio of HBO, TNT Sports, and other TV networks, and the film business with Discovery's group of pay TV networks, which was a very significant international group of networks. Ever since, the company's been working to lighten the debt load stemming from that merger. While the company has repaid $19 billion in debt, it still has below $34 billion in net debt, so that would be total debt less the cash on hand. So that's how you get from 37, let's say, to down to 34 roughly. And that's as of the end of the first quarter, according to the CFO. Who is the guy who would know? And if they just continued the way they are as one company right now and they kept paying down that debt and all things stayed the same, maybe they could pay the whole thing off in another 6 or 7 years or something like that. Maybe not. Companies operate with debt. It's normal to operate with debt. It just depends on what is your business structure, what's the capital structure, like the debt versus the investment, and what makes sense for you as a company so that when the marketplace looks at it and they decide, okay, I want to invest in this company, I see how they're going to operate and I can see how their value is going to increase over time by their activities, and their financing looks right, and their necessity to even borrow money is appropriate given what the market rate is for interest. That's another outside consideration. They have to get the company like formatted to do business in this entertainment environment, in this streaming environment, and in this environment for debt and borrowing money and the whole like business structure and operations. Last month, S&P Global Ratings cut Warner Brothers' credit rating to junk status, citing the continued revenue and cash flow declines in the traditional TV business. Junk status doesn't mean that you're not going to pay back the money. It just means when you look at the revenue that's coming in versus the expenses that you already have, and the outlook for the market that you're in with what you're doing and making and sending to your customers, it ain't looking so great. You're less likely to be able to pay your bills than you were a few months ago. And when people talk about companies having trouble, the first thing that you ought to look at is, well, what is their debt rating now? And what did it used to be like 3 months ago, 6 months ago, a couple of years ago? Look back at it. When you get to junk status, it's not a major plus, but it doesn't mean that you're necessarily going out of business. But it does mean that that financial structure should change if it's possible to change it. One of the ways you would change it is by getting a new investor, using that money to pay down the debt. So you had like better financial ratios so that you owned a lot more than you owed, or at least that you owed less than you own, like a consumer credit rating. Or in the case of Warner Brothers Discovery, split into two companies, get some new investors investing in the two different formats that you have now, and create some money out of thin air, which I think you're going to successfully do. But it's safe to assume that the majority of the debt is going to live with global networks, that's the cable channels, and a smaller portion, but not insignificant portion, on streaming and studios as well, said Wiedenfelds. Both companies are expected to have strong liquidity, particularly in the global networks business, which is projected to generate significant free cash flow that will be used to further repay debt. Strong liquidity means they just have a lot of money coming in so they can pay their bills. They can't fix Warner Brothers Discovery, but they could split it into two companies, and that would fix the problem. Let me know what you think of all this in the comments below. Always love to see your ideas. Please be sure you are subscribed to the channel. Click the bell for notifications. Give me a thumbs up, and I'll see you again soon with another story. And if I don't see you, I will miss you.